Hello, my name is Kevin Reeves, and I'm an independent consultant and quantitative developer based in Chicago, Illinois. Today I'm going to continue my series of video walkthroughs on some algos that I've developed for the Option City Freeway algo trading platform. Today our focus will be on the Auto-Hedger job, and this algo is publicly available in the Option City Algo store. I thought I'd start by mentioning a blog post I recently authored, and the URL is here if you're interested in reading. In this article, I mention a number of notable themes that I've seen developing over the last few years in the algo trading space. One of the points I make is that there's a lot of value and differentiation offered through fully customizable algos. And by that I mean algos where all of the relevant operational parameters are exposed to the user. I didn't mention the Auto-Hedger in that article, but it's actually a perfect example of what I was talking about. Hedging is a nearly universal need for options traders, but there are many different ways it can be done. There isn't necessarily one right way. The preferred hedging approach taken by any trader is going to be dependent on a lot of different factors, including the market he's in, the market conditions, the firm he's at, the particular appetite for risk, as well as many others.
So what is the Axiometric Auto-Hedger job all about? Well, it's a delta and gamma sensitive automated hedging tool that supports both passive and aggressive execution. Aggressive execution is where a trader pays a price premium in exchange for the comfort of immediate execution. We can quantify the magnitude of this price premium in various ways, but let's oversimplify here and say that it's approximately half the width of the spread. This is the amount extra the trader pays in order for immediate execution to occur. Conversely, passive execution is where a trader works an order, usually a limit order, at a preferential price, but in doing so he takes on an additional risk associated with time. In other words, the market could very well move unfavorably rather than favorably. However, even with that risk stated, it is generally a true statement that in most common scenarios, a mixture of aggressive execution and passive execution is preferable to a strategy which involves aggressive execution alone. There are a lot of different reasons for this. It can be demonstrated theoretically, and I've also seen empirical evidence presented by some clients who have run side-by-side tests in which they have literally side-by-side compared immediately executing the hedge versus working some percentage of the hedge burden. And all the evidence I've ever seen has suggested a significant and positive impact of using passive execution. There are a number of factors why this is the case. When you're working an order, you have the ability to leverage statistics and various heuristics in order to help you select the best price and or the best time in which to execute your future lots. Secondly, by working a quantity, you leave the door open for future delta offsetting. In other words, it's almost like an opportunity credit. By maintaining a working quantity, you might be able to offset some of that or all of that quantity in the future without even having an execution occur, which obviously saves you on commission and transaction fees. So the Auto-Hedger is important in delta neutralizing options trades and option strategies trades. The Auto-Hedger can be assigned responsibility to hedge any filled quotes regardless of whether or not they originated in Metro or by a Freeway algo, such as the Auto-RFQ algo. Also, the Auto-Hedger can take responsibility for any orders generated in Freeway, and that includes the Profiteer algo, which I went over in a prior video. Also, Option City will be adding support for Freeway auto-hedging responsibility in the manual order entry dialog in the future, and check with them for an ETA on this if this is important to you. I don't have an exact time, but I do believe that that's coming. Lastly, this is currently under development. The job will also be able to take control of manually entered working orders that meet certain user-defined criteria. So you can see between these four different funnels that the Auto-Hedger can do a pretty comprehensive job of hedging incoming trades. So increasing hedging efficiency is an important aspect of the Auto-Hedger algo. It can offset deltas via four different independent levels. At the highest level, we have inter-algo handoff. Some algos, and the future scalper is a perfect example of this, develop liquidity reservoirs during the course of their normal operations. So this is great if we have an incoming hedge request that can be offset with an already established position in another algo. That is a risk-free and a commissions and expense-free trade-off, and that hedge request can be handled immediately. Secondly, we have an optional feature of the Auto-Hedger algo, which is a delta accumulation queue. And this is a powerful feature, which I'll get into more depth on later, that can allow you to offset hedge requests via proximity and time. Third, the point that was already mentioned previously is that when you're working a futures quantity, you have an opportunity credit, and that those quantities could be partially or fully offset by new incoming hedge requests. And lastly, fractional remainders of hedges already filled can be used to offset incoming hedge requests. Now, this is a relatively minor effect since it's only a fractional part of a future, but certainly it could add up. So let's discuss in some detail the delta accumulation queue. There are two main user-defined parameters which control the operation of the queue. The first is a rolling time window, which is user-defined, and this can be anywhere from seconds to hours. And you could also put 0, which means no queue at all. So this is an optional feature, but if you set it up, you have a rolling time window, and during the course of this time window, hedge requests which are processed by the Auto-Hedger, which are less than a certain user-defined threshold called the accumulated delta hedge trigger, these will be put into the queue. So, for example, let's say we have a delta hedge trigger of 50, and the prior slide talked about some notation and some convention. So 50 delta would represent the amount of delta of 1 at the money call. Negative 50 would be 1 at the money put. 1 long futures is going to give you 100 delta. So if you have some incoming hedge requests that are less than your hedge trigger, they're going to go into the queue. And here I have an example of 20, and then after that came 6, and then came 14. So maybe these were some strategies. These are typical kind of deltas that you might see on some strategies. And so if you add these up, 20 plus 6 plus 14, you get 40, which isn't enough to meet our 50 delta hedge trigger. So these things are just going to sit in this queue. Now, if another hedge request came in that had 10 or more, well, that's going to push the total over our hedge trigger of 50, and that's going to then be turned into a working futures lot. Or it could also be an aggressively executed futures lot, depending on some other settings, which we'll get into later. Now, on the other hand, let's say you purchase an at-the-money put. Well, now 50 comes in, and he takes out all 3 of these items, nulls them immediately, and you're left over with approximately negative 10 delta sitting in the queue. So by controlling the length of the time window and by setting the accumulated delta hedge trigger to a value that you like, you can control sort of this integration or accumulation of delta over time. And you could very well set the delta hedge trigger, to be 500 or to be 1,000. If you set it to 1,000, you're basically saying that you're willing to play, with up to 10 futures worth of delta on the table at any point in time. And it's also important to note that the deltas in this queue are not static. The queue is constantly reevaluated to incorporate the effects of gamma, so that if the deltas are shifting around based on a changing underlying, these numbers will be reevaluated at each point in time so that you have an accurate representation of the delta. So this is a very powerful technique that allows the user a lot of control over the level of hedging activity that they wish to have. And if entries fall off the back of the time window without ever accumulating enough to reach a trigger point, then those entries are actually forgotten. And so in some cases that's actually beneficial. So anyways, hopefully that is a fairly clear explanation of how this works. And if anyone has any specific questions, feel free to email me. My email will be at the end of the video, and I'll be happy to answer any questions. So here we have a picture of a demo spread, which is going to be useful here in a little bit, because what I'm going to do is I'm going to open up Freeway and just show how easy it is to get set up with this algo and go over some of the operational parameters. So here we see the Freeway server and a few Algo instances that have already been installed on the server. Here's the Auto-Hedger job. So we'll just open up the dashboard file, which controls the interaction with this algo. So here are the two grids that do that. So we'll start with the mappings grid, and here we'll double click on the instrument cell, and when this opens up, we'll be able to select the options or strategies that we want this row to be associated with. So here, let's pull in all the outright options for the ES contract with the June 2014 expiry. So we see 468 match. If we hit apply changes, that'll populate these breakout columns right here, which are just there for readability and convenience. We can select quotes also if we want to also handle filled quotes for these outrights. And the hedge quantity percent, this tells the algo what percentage of the filled quantity that it should try to hedge. If you put 100, it's going to try to delta hedge the whole order or the whole trade. And if it's less than that, you can do 50% or whatever. This column right here, the hedging future, if you leave it blank, it's going to use whatever the default future is attached to these options in the system, which in this case is going to be the June 14 ES future. However, if you want to here, you can override that with another future. If for whatever reason, say you're getting close to roll time and you wanted to go, to set, you can go override that here. Or if it makes you more comfortable, you can just, explicitly specify what you'd expect anyways, just so you know for a fact what it's doing. And there are some cases, if like, for example, this involved a calendar spread across 2 different months, then you would actually be forced to use this column because the Auto-Hedger would recognize that there's ambiguity in which month should be used to hedge, and then it will actually tell you that you would need to explicitly set the hedging future in that case. But if you don't specify this in general, it will use the default future attached to the option in the system. So we could give this a label. And, we could set up another row here. So we could, let's say all the September outrights. We got 46. So now we have another row in which all the outrights are going to come through and be auto-hedged via the sept ES future. So these 2 rows don't have any overlap, but there's no problem if you want to have overlap. You can have like a catch-all row, and you can build a hierarchy of other rows that are more specific. This can be useful with strategies, for example. You could have, like a catch-all strategy row, and then you could have another row which is just for the straddles, or whatever breakdown you wish. If you wish to have different parameters, maybe you want to handle the quotes on some and not the other, or maybe you want a different hedge quantity percent or a different future to hedge with. And it'll basically look at this priority column. If it matches more than one row, it'll pick the row with the lowest priority if the numbers are placed here. If there are no numbers here, then it will basically select the matching row that has the most specific expression. So for example, if you had ES strategies as a catch-all row, and then you had, ES September strategy straddle type only, it's obviously going to pick that second row because assuming that the incoming trade was off a straddle, that obviously that straddle matching string is going to be a lot more specific than catch-all. So if you don't put priority in here, the algo will intelligently determine priority based on the specificity of your instrument matching string. So let's just say we tried to activate these two rows. Now, I know it's not going to work, and that's because we haven't set up this hedging future in the hedging parameters grid. This row did turn on because I didn't specify an explicit future here, and so there's nothing for it to go check over here yet. But if a September outright trade did come through and it looked up the default future, which is going to be the SEP14 in that case, and tried to go over to my parameters grid and didn't find that future in here, it would then give you an error or a warning in the log at runtime because it doesn't have the hedgers it needs in order to hedge that September future. And in this case, because we explicitly specified a future, we can go to the log and it will tell us flat out that it can't be activated because that future is missing. So what we need to do is go to our second grid and we need to set up our future. So this future, the June 14 ES, now corresponds to this one right here. And you could have multiple rows in the mappings grid all pointing to this, same future. And they're all going to go get funneled into this row right here. Now, the rest of these parameters are the hedging parameters that tell the algo the details of how to deal with hedges for this particular future. So we'll start going from left to right here, and hopefully I'll be able to explain what each of these columns does, and it will be clear to the listeners. So this first column is max working quantity, which is the greatest number of future lots you're ever willing to work at any one time. So if you were to put 10 here, no matter what the hedging burden coming through, you're never going to have more than 10 working at once. So if that 11th hedge was needed, that's actually going to be aggressively executed because it's exceeding your working quantity. If you put in 0 here, then you would effectively be sending every incoming hedge directly to aggressive execution, which from the previous points we spoke about in the beginning of this video, that's probably not ideal because there's a tangible advantage from working futures. So in most cases, the user is going to set this to a certain level which meets their comfort zone. Here's the accumulated delta hedge trigger, which is from that delta accumulation queue that we already went over in the prior slide. So here 50 would mean that once 50 delta accumulated, you would initiate a hedge. In that case, it would round up to the next future. So 50 delta, you purchase an at-the-money call, it's going to round up to one future lot. If you don't like that roundup behavior, you could put in here, 100, and then you're going to need a full 100 delta before you start to try to work that futures lot. And also, as I mentioned in the prior slide, you can set this to an even greater value. You could say 500, which basically means that you're willing to accumulate up to 500 delta in either direction in your accumulation queue before you actually take action and work the hedge. Here's the delta accumulation time window, which was also mentioned in the prior slide. And this is in seconds. So, you could set this to 60 seconds and you have a queue that's a minute long. Or maybe you find it far more useful to set it, on the value of an hour or two, in which case it would simply be, it would be, let's say you wanted to set it to a 2-hour, window. You're going to have, 2 hours times 60 minutes times 60 seconds. And rather than do the math in my head and embarrass myself, I'll let the reader do that. But whatever that number is, you could set that, and you're going to have a 2-hour-long queue. The minimum side quantity ratio and the required working side quantity, these are two heuristic settings that you can specify if you wish to try to take advantage of a known fact that the side quantity ratio showing on the spread does give some indication of the direction the spread's heading on a statistical basis. So if you set this to 0, you'd effectively be turning this heuristic off. But if you set it to 0.3, you're basically saying that if I'm working a buy order, then I'm going to require that the ask side of the spread has at least 30% of the quantity total, which would be if I added the bid and the ask sizes together. So, if the ask is showing 10 and the bid is showing 50, well, that would violate my quantity ratio because 10 divided by 60 is less than 30%. Likewise, this is a related but somewhat different criteria where you can basically say that if you're working a buy order, for example, you're going to require that the size showing on the ask is always as great or larger than the size you're trying to work. So if you're working a 10 lot order and the ask size drops below 10, regardless of how much size is showing on the bid, you're going to try to move your working order into immediate execution because that working side quantity has been violated. So these are both optional heuristics that some traders like to use in order to try to figure out a time when it's best to stop working and execute. So working offset and ticks, this is an important value. It's often 1, but this can change depending on the market and the user's preference. But this basically tells you how many ticks away from the execution side of the spread are you working your order when you're working futures lots. So if I go to our sample spread, here's an imaginary spread, and let's say that one price unit is 1 tick, and here we have a fake ask and a fake bid. And let's say that we're working a buy order and it comes in right here, and if we've set our working offset and ticks to be 1, what that means is that our initial working buy order is going to come in 1 tick below the ask because we're trying to get 1 tick preferential price. And so here it is, it sits. And that's when we're in the period of working that order. Now, let's say that the market moves unfavorably in this case. So the ask goes up. Now, normally your working order is going to follow the unfavorable move, maintaining the 1 tick offset. And that factor that controls that behavior is right here, which is the working slippage in ticks. And so here we could say 1, for example, which means that we're willing to follow the market unfavorably 1 tick away from where we start. So that would be this tick right here. And we would continue to work right here. Now, if the spread downticked, our working order is going to get filled as the ask moves into us, and we're going to get filled at this point right here, assuming that a complete fill happens. Now, the next column is the max working duration in seconds. And if you set this to 0, that means that this is not turned on. But if this is greater than 0, you can specify the maximum number of seconds in which you're willing to work any futures quantity. And this is tracked on a per lot basis. So some users have interest in, let's say this spread just stayed flat and the working order was just staying flat. Some users like to be able to say, after a certain period of time, I'm going to execute my working lot, even if the spread hasn't moved and no other criteria would normally be telling me to exit for whatever reason or for risk reasons. After some period of time, I will aggressively execute that working lot, which means that I'm going to take the ask price because I'm attempting to aggressively execute. So the aggressive execution itself is controlled by two parameters, which are right here. So you have the execution order type and the execution padding, which is in ticks. Now, the execution order type can be either market or limit. So if you do a market order type, then your aggressive execution orders are guaranteed to get filled. So in the case of a working buy order, let's say right here our working slippage was 0, which means that we didn't allow it to go up to follow the unfavorable move. So what would have happened is when this move occurred, rather than follow it with our working order, we would have attempted to immediately and aggressively execute the quantity on the current ask, which would have been at 1502 right here. And so we would have sent out a market order for our quantity to get filled at 1502. Now, some traders prefer to use a limit order in order to minimize the risk that can happen. Sometimes with market orders, you can get filled at a price other than you expected. With the limit order, you can specify the exact price, and you also have this padding factor which comes into play. So this column is only relevant if limit is selected here. And if you have this set to a number greater than 0, it's going to add some padding to the price. So for example, if you have limit aggressive execution order type, and using our same example, let's say you're working the buy order here, and you have your execution slippage set to 0, which means you're not allowed to follow the unfavorable move. So at the time that this spread upticks, you're going to immediately try to aggressively execute on the current ask, which is at 1502. Now, if we're using a limit order and we had 0 padding, we would put in a limit order right at 1502. And what you do by that is you guarantee a price no worse than 1502. The risk to that, however, is that if the price continued to uptick to 1503, you might have an unfilled or partially filled limit order resting here at 1502, and that's an unmanaged order at that point. Once the Auto-Hedger goes into aggressive execution mode, it no longer will actively manage the orders. It only actively manages working orders. So if you fire a 1502 limit order and it misses or doesn't get fully filled, the price could continue to extend and you have an unmanaged order sitting there for the rest of your quantity. However, you could also put in a padding of 1 tick, in which case it's going to actually produce a limit order at 1503. And the exchange will match you at the best price available. So if the top of book is still 1502, then your aggressive execution order will still get filled at 1502. But if there wasn't enough size there to completely fill you, or the ask continued to uptick, then you would also have the chance to get filled at 1503. So these are sort of subtle nuances that are specific to the trader. Some like the market, some like the limit, and you can pick what works best for you and for your taste. But these two columns basically control the manner in which aggressive execution occurs. So these next two columns are optional add-on components that I've integrated to work with the Auto-Hedger. And they're not required by any means at all to use the Auto-Hedger. The Auto-Hedger is a very powerful tool without these things. But if you choose to use either or both of these features, you can have a more sophisticated quantitative approach to how you handle your working conditions. Now, the Fast Futures algo was showcased by Scott Morris a month or two ago in a webinar. So viewers who are interested in learning more about his algo should refer to that prior webinar, and they can view the details of how his algo works. But basically, he has a quantitative model in which he uses statistical information in order to try to predict upcoming changes in the bid or ask. So obviously, if you've got his algo running and that's feeding information to the Auto-Hedger, and then it predicts an unfavorable move that meets your level of significance, then the Auto-Hedger is going to stop working your quantity and it's going to move it into aggressive execution mode immediately, hopefully getting filled before that predicted move happens. The anti-flicker is a separate technology which I've developed, which is somewhat different than the fast futures. The fast futures is trying to predict upcoming bid and ask moves, and the anti-flicker is somewhat different in that it basically is detecting the significance of moves when they happen. And so it basically is able, it looks at some different information and is able to differentiate on a statistical basis between spread ticks that are significant and those that aren't. And that allows it to follow a more stable spread. And I'm not going to get into all the details because these components themselves are probably worthy of a full video. And this is not the time or the place to, it's outside the scope of what I'm trying to accomplish in this video. You know, like I said, please see the webinar by Scott Morris and Option City. It's on the Option City website to learn more about his fast futures algo. And, you know, I do have one graphic here I'll show. The anti-flicker technology basically is a quantitative technique that I've developed that predicts significance of spread movements. It actively and continually collects statistics, allowing it to adapt to any market or market period. I've tested it both overnight and during the active trading periods, and it typically runs at 85 to 95% efficiency across all the markets I've tested so far, and that includes ES, treasuries. I tested it on gold, which has a fairly difficult spread to deal with. The gold spread does tend to expand and contract a lot. And so here's a sample data. Well, I mean, this is real data that I've collected on the ES June 14 future. This is approximately 1 hour period intraday. And so the bolded blue line represents the spread as computed by the anti-flicker technology, and the bolded purple line represents the ask as computed by the anti-flicker technology. And so you can see the unbolded lines represent the actual real spread movements, and you can see that there's a lot of high frequency noise. It almost looks like hair, and that's the spread jittering about. Each one of these is an uptick or a downtick, and you can see that the anti-flicker technology obviously eliminates a good percentage of this noise without sacrificing much accuracy on the overall spread, which is definitely an appealing component. You know, because if you're working an order, you know, say you're working a sell right here, and you know, the real life bid drops down, and the real life ask also drops down, and you're sitting with your working order right here because you were, let's say you're working one tick above the bid. So if you followed that market movement down, if your working slippage allowed it, you would now be working your order right here. Well, then you can see the spread comes right back, and you would have got filled at the less preferred price. Whereas the anti-flicker technology would have maintained your working order at the original price because it never saw these moves as being significant. And then the spread would have returned and then went the other way, and you would have indeed been filled at the preferential price. So again, I'm not going to get too much into this because this is a pretty complicated aspect in itself. But the takeaway here is that between the anti-flicker and the fast futures algo, you have two different ways to really optimize the details of your hedging behavior, and you can really add some real power to working quantity. And this can be a big deal because, I mean, when you're working quantities and you're able to save a tick here and there on a statistical basis, you multiply that by your working quantity. I mean, this can add up to be a serious effect every single day. So these two items, I'm not trying to undersell them by glossing over them. They're incredibly useful and powerful features. It's just that I don't have the time to get into all the details at this point. Lastly, we have the account override column here, where if you wish, you can set in a specific account to use for this particular future hedging operation. And if you don't specify anything here, it'll just use the default account that the job is attached to. But you know, using this kind of setup, you can have, you know, different futures going to different trading accounts if that was useful for your operation. You know, we can set up another row here for the bonds, and we can give it its own set of unique parameters. Put a 5-minute delta accumulation queue. You know, maybe here we don't care about these side requirements. One thing I will say is that some of these side requirements are superseded by the anti-flicker and the fast futures algo. These algos both are making use of the statistical information in a much higher level than these simple heuristics can do. So if you're using either of these two, selecting these options are not allowed because they're actually counterproductive. The anti-flicker or the fast futures are actually giving you better information at all points in time than you would get using these heuristics. So there you have it. I think that's about it. There's just these two grids, and I've gone over all the important columns. The Auto-Hedger can tangibly impact the bottom line by improving hedging prices and hedging efficiency. The ability to offset deltas is very important, you know, especially if the trader is able to take trades that are within a proximity in time are able to offset each other without requiring a hedge execution. With tight markets, where edge may be smaller and frequent, it's often true that the better futures hedge price can be responsible for the bulk of the trade's profit. You know, this is not always the case, but when the markets are tight, hedging becomes a more important aspect than it might be otherwise. So if anyone has any questions or feature requests, please email me. My email address is here, and I'd be happy to address any questions or feature requests. If anyone has any general questions regarding Freeway, they should reach out to Option City, and I'm sure any of the representatives there will be happy to assist them with any questions that are for Freeway. So thanks a lot for listening.